Tesla and SpaceX merging into one company? That conversation took its sharpest turn yet today. A top Tesla analyst put an actual date on it, and it landed on the very afternoon SpaceX joined the same stock indexes Tesla sits in. We've also got Elon Musk calling Tesla's production shortfall insane. Two well-known investors landing on opposite conclusions about the stock, California stacking truck incentives to $250,000 a vehicle, and a delivery number a week away that settles a real argument. This is the Tesla Brief, after the close on June 26th. Welcome to the show. A quick look at the stock. Tesla closed up 1.4% at $379.71, while the Nasdaq slipped about 0.2%, and the S&P 500 finished basically flat. So Tesla rose, while the broad market drifted sideways. A company-specific day, not the market pulling it along. Let's start with the merger talk, because it got more concrete today on two fronts. Gene Munster of Deepwater Asset Management, a long-time, generally measured Tesla and Apple analyst, was asked on the Risk Reversal podcast whether Tesla and SpaceX eventually end up under one roof. His answer was unusually direct. He said, quote, "I'll take that. Tesla's part of SpaceX in the next 3 years. Here's why that's worth taking seriously, rather than treating as idle speculation." This is the same week, several separate things all pointed in the same direction. SpaceX recently went public, so for the first time, both of Musk's biggest companies trade on the open market. Musk crossed 20% of Tesla's voting power. A major Wall Street firm put real odds on a merger earlier this month. And after today's close, SpaceX got added to the Russell US stock indexes. That last one sounds technical, but the mechanism matters. A lot of money sits in funds that simply mirror an index. They own whatever's in it, in the same proportions, no stock picking involved. When a company gets added to an index, every one of those funds has to go buy it to keep matching. In SpaceX's case, that's roughly $3 billion of forced buying. And SpaceX is set to join the Nasdaq 100 in early July as well. For Tesla shareholders, the significance isn't the $3 billion. It's that SpaceX now lives in the same index homes as Tesla. It gets the same automatic buying, shows up on the same screens, and gets measured against the same yardsticks by the same fund managers. That's the structural setup that turns a merger from a thought experiment into something the plumbing of the market could actually accommodate. Now here's the part worth sitting with. And what he's effectively describing is a future where the most likely path for Tesla shareholders is to end up owning a smaller slice of a bigger, Musk-controlled company. That is the exact outcome that worried some investors when SpaceX went public. So a bull and a skeptic can look at the same set of facts and describe the same event. They just disagree on whether it's a good thing or a bad thing for the people who own Tesla today. The honest read is that the question has shifted. It's no longer whether the conditions for a combination exist. Between the shared index home, Musk's voting power, and the analyst commentary, the setup is clearly there. The real question now is what terms Tesla's board would actually accept, and whether ordinary Tesla shareholders would get a fair deal. Nothing has been proposed, but this is no longer a fringe idea, and it's worth watching how Tesla's board frames it if it ever becomes real. Munster had a second point from that same appearance, and it's a useful counterweight to the merger talk. He told the panel that his own experience driving on full self-driving over the past 6 months has been little to no interventions, meaning he rarely has to grab the wheel. His line was, quote, "My sense is that they're closer to full self-driving than the market believes." He pointed to Tesla's own data that FSD is roughly 7 times safer than a human driver, and said even if you have that to be cautious, it still matters against more than 42,000 US road deaths a year. The numbers he leaned on for scale are the interesting part. FSD is currently running about 0.5% of all US passenger car miles, and self-driving makes up only around 2% of rideshare trips. In other words, if the safety case holds, the room to grow is enormous. Almost the entire market is still ahead of it. Set that against Gary Black, who runs the Future Fund, and you get a clean picture of the disagreement on this stock. Black's read on the broader market this week was constructive. But on Tesla specifically, he stayed cautious, for the second day running. His reasons? Forward earnings estimates that are drifting down, autonomy competition heating up, and a stock priced at roughly 200 times next year's expected earnings, against long-term earnings growth of about 35%. What's worth noticing is that Munster and Black aren't actually arguing about whether FSD works. They both think the technology is real. They're arguing about something different, whether the stock price already bakes in everything Tesla could become. Munster thinks the autonomy progress is underpriced. Black thinks the expectations are already sky high. That's the genuine debate on Tesla right now, and it's a more useful one than the usual does it or doesn't it noise. That debate runs straight into something Elon Musk posted today. Replying to a thread about demand for Tesla's vehicles, he wrote, quote, "The production shortfall relative to demand is insane. Much higher production is needed, with much in capital letters. Take it for what it is, a CEO post, not formal guidance, and it sits in direct tension with the bear case." Gary Black's caution rests partly on falling forward earnings estimates, which is the sell side effectively modeling a softening demand picture. Musk is publicly saying the opposite, that Tesla can't build cars fast enough. They can't both be right. The fair caveat is that Musk didn't say which product he means, the Cybertruck, the Model Y, the Semi, and Tesla doesn't break out its order backlog by model. So the claim only really matters if it's about a high-volume line. And it's worth remembering Musk has used demand is insane language before, both ahead of price increases and ahead of new launches. Either of those would shape the next delivery number. On that production theme, there's a concrete demand lever showing up for one of Tesla's slower-moving products, the Semi, its electric heavy truck. Tesla confirmed that 2 California incentive programs now run side by side. The state's Clean Truck Voucher knocks $120,000 off each Semi for up to 20 trucks, with no requirement to scrap an old vehicle. And starting tomorrow, a second program, the Clean Fuel Rewards Scheme, adds another $120,000 per truck, with no cap on how many. Small fleets can stack both, which means up to $240,000 off a single truck. Tom Zhu, Tesla's most senior global vehicle executive, amplified the announcement. Here's why that's more than a footnote. The Semi has mostly been talked about as a someday catalyst, not a line on today's income statement. A $250,000 subsidy stack is exactly the kind of policy mechanic that can pull real Semi orders forward into this year. Which matters, because Tesla's new Semi factory in Nevada is ramping, and analysts have barely pressed the company on it yet. Stepping back to the competitive landscape, Volkswagen is reportedly weighing the biggest restructuring in its history, considering closing 4 German factories and cutting up to 100,000 jobs. Its shares are down about 60% over the last 3 years. This fits a wider picture that's been building all week. A legacy German carmaker that bet big on electric is contracting hard. Toyota is on track to pass GM as the top seller in the US for the first time since 1931. And Tesla is openly saying it can't build cars fast enough. The thread tying those together is that the shift to electric keeps moving market share away from the legacy players who can't get the manufacturing economics to work. For Tesla in Europe specifically, where its Berlin factory just lifted output to 7,500 cars a week, a shrinking Volkswagen is a quiet tailwind. The thing to watch is whether it shows up in Tesla's June European registration numbers in mid-July. One macro note, because it's a genuine near-term swing factor, rather than background noise. Ed Yardeni at Yardeni Research read Kevin Warsh's debut as the new Fed chair as the version favoring higher interest rates winning, meaning Warsh is leaning toward higher interest rates with at least one hike possible before year-end. His point, core inflation just hit 3.4%, the highest in 8 months, even as oil prices collapsed after the Strait of Hormuz reopened. The offsetting force, he argues, is the AI build-out itself, which is pushing electricity and chip prices higher. Why does this touch Tesla? Higher for longer interest rates weigh hardest on companies whose biggest payoffs sit years out. Robotaxi, Optimus, FSD. That's the mechanical reason the high-priced AI-adjacent stocks sold off earlier this week. Tesla shrugged that off today and rose anyway. The next thing that moves this is the Fed's preferred inflation gauge, due next Thursday, which brings us to the thing to actually watch. The biggest Tesla catalyst before late July earnings is about a week away. The second quarter production and delivery numbers, expected on the first business days of July. So Wednesday the 1st or Thursday the 2nd. That print is the referee for the argument running through this whole episode. Elon says the production shortfall versus demand is insane. Gary Black points to forward estimates that are drifting lower. One big Wall Street bank raised its second quarter forecast above the consensus earlier this month. One of those views is wrong, and the delivery number settles it. No commentary, no spin, just how many cars Tesla actually delivered. And the same window is busy. BYD's June numbers give the clearest head-to-head read on Tesla's biggest rival, and the US jobs report and the Fed's inflation gauge land in the same few days, feeding right back into that interest rate question Warsh just made hawkish. So the first week of July is a heavy one for anyone following this stock. We'll be here to walk through the delivery number the moment it lands, That's the Tesla brief for today. If it's been useful, please subscribe. Thanks for joining us, and we'll see you in the next episode.